Welcome back to the deep dive. Today, we're opening up a really specialized piece of market intelligence.
Yeah, this one's quite specific.
It is. It's the LoopMarket Weekly Structure Report for the week of October 20th to the 24th, 2025, authored by Devin McClarty, owned by D Investment Enterprise.
Right.
And it gives this, well, fascinating look at how highly structured, maybe institutional capital behaves.
That's the key, I think. Structured.
So our mission today really is to unpack the central idea of this report. It's got this provocative thesis that structure itself, not, general market mood or chaotic swings.
Right. Not volatility.
Define this 5-day period. The summary is pretty bold. The weak structure won.
Yeah, and that phrase, it's not just a catchy title, is it? It really sets the whole analytical frame.
How so?
Well, when you read the report, you're seeing this detailed breakdown of how the market's systemic design, sort of its internal plumbing, just prevailed over all the emotional noise, the reactive trading. The report calls the overall tone measured expansion.
Measured expansion.
Okay. Yeah. So for you listening, the argument here is that momentum, it was only rewarding people who were extremely disciplined. No speculation allowed, basically.
So this is really a deep dive into looking at the market almost like a machine running on a specific script.
Pretty much, yeah. A governed system.
Okay, so let's unpack that. Saying structure one sounds compelling, but what specifically showed that? How do we know the usual emotional reactions weren't in the driver's seat? Was it just low volume?
Good question. It really boils down to how consistent the capital flow was. The core idea here, based on McClarty's analysis, is that structure beat sentiment because the money was moving in line with a predictable design.
Predictable? How?
Well, the data showed that consistency, the repeatability of the flow, it was the #1 source of alpha that week.
Okay.
We weren't seeing these wild, chaotic surges. We were seeing what the report calls governed velocity.
Governed velocity, I like that term. So a speculation is like reactive volume spikes or just buying everything?
Yeah, indiscriminate buying.
Then governed velocity sounds more like disciplined momentum, like big players moving capital on a schedule almost.
Exactly. A predetermined schedule is a good way to think about it.
So what difference did that make on the charts? How did it look?
Well, it led to this exceptionally clean split in the market. Sector polarization.
The Great Divide, as the report calls it.
Precisely. And this wasn't just guesswork. The internal heat map data and their proprietary EV% metrics, they confirmed these really clear surgical decisions were being made.
So capital wasn't just flowing around vaguely, it was being actively reallocated.
With serious intent.
Yeah.
You saw this definite split between two groups, the engines and the drag.
Okay, let's start with the engines. The leaders, or the beat segment, I think they called it.
That's right, the beat.
And that was the growth stuff. Tech and healthcare.
Yeah, they led the market decisively. The report says they operated like controlled engines.
Controlled engines.
And there are specific examples. Take technology, HPE. It showed what they call a dominant EV% spread. And get this, it closed the week at its strongest point since June.
Okay, hang on. We need to pause there. EV% spread. That sounds like their own metric.
It is, yeah.
For everyone listening, when it says HPE had a dominant EV% spread, what does that actually measure? How does that prove it was a confident institutions, not just, meme stock hype?
Right, crucial point. So the EV% spread, it's basically measuring how effectively the trading volume was distributed compared to its usual historical patterns.
Okay.
When it's dominant, it means the volume happened at very specific times, often institutional order windows, showing this persistent non-reactive buying.
So it's not just volume, but when and how the volume occurred.
Exactly. A dominant spread suggests big blocks of capital were deliberately taking positions over the whole week. It's the total opposite of those flash-in-the-pan speculative spikes.
Got it. So it shows quality, persistent commitment, and healthcare showed that too. USPH.
Absolutely. USPH showed sustained rotation inflow, multi-day strength. This wasn't just a one-day pop. It really signaled a strategic bet on that growth story from the big players.
Okay, so that's the beat. Now, the counterweight. The drag, the laggards. These were the defensives, right? Stuff that normally holds up okay in rough times.
Usually, yeah. But this week, they basically became the funding source for the winners.
The defensive drag.
Exactly. Defensives and telecoms. Specifically, the report flags HSY in defensives and RCI in telecom.
Okay.
Both were stuck deep in profit-taking territory, just consistently seeing capital flow out. The report called them pressure zones.
And this is where the structure part gets really interesting, isn't it? It wasn't just rotation towards growth. It was specifically rotation out of these safety plays. The report claims the outflows from HSY and RCI were the direct liquidity engine for the inflows into HPE and USPH.
Think of it like a super efficient fuel transfer.
Okay.
The market wasn't really waiting for new money to come in. Instead, the cash being pulled out of HSY and RCI, that persistent selling, was being directly funneled, siphoned off, and put straight into HPE and USPH. It was a surgical reallocation.
Wow. Taking profits from safety, immediately deploying into high conviction growth.
Exactly. That kind of precision, that coordination, that's what structure winning looks like in practice.
That really helps visualize it. It's like one big coordinated institutional move. But if it was that precise, how did it play out day by day? Because that leads to maybe the most compelling evidence. The repeatable daily pattern.
The daily rhythm, yes. That's the hallmark of a market following a script.
Right. So what happened?
Every single day, Monday, Tuesday, Wednesday, Thursday, Friday, the same pattern, beat, match, lag, like clockwork.
Okay, walk us through that. What does a Monday look like?
Right, so Monday, October 20th, you had the beat green, HPE and USPH pushing things forward, especially at the open in the last couple of hours. They were the drivers.
Okay, the engine's firing.
Then you had the lag, red. HSY and RCI acting as a drag, consistently bleeding capital. They were the source, the funding, through steady selling all day.
So those two ends were the active parts, the push and pull. What about the middle, the match, orange?
That sounds like the key to control, right? Stopping it from just being chaos.
Exactly right. The match segment was the anchor. The report highlights WU in fintech. Now, WU just consolidated. It held its base all week.
It didn't join the party, but it didn't collapse either.
Precisely. It didn't get pulled into the growth beat, but critically, it also didn't succumb to the defensive drag.
Why is WU just holding steady so important? Couldn't that just be apathy? Low interest. Why call it capital flow control?
Because if the market was truly volatile or nervous, unstructured, right, money would either flee to the safety of things like HSY or it would just pull out of everything, and WU would likely break down below its support levels. The fact that WU held firm, especially with a neutral macro backdrop and this intense polarization happening elsewhere, it confirms the flows hitting HPE and RCI were incredibly focused, contained.
The market wasn't panicking. It was executing a specific plan.
Exactly. The anchor held. It proved focus, not fear. And speaking of containment, there was also that whole neutral segment list, wasn't there? MRNY, PSKY, CHCT, CONY, a bunch of others.
Yeah, PSPY, CCIF, IQI, GPK.
And it just did nothing. No significant EV % movement all week.
Basically flatlined, yeah. And the stillness, that's actually really telling.
How so?
Because when you have a whole list of stocks that are essentially ignored by the flows, it tells you the market's energy was laser focused on the engines and the drag.
Right.
There wasn't widespread systemic volatility because the capital deployment was so narrow, so intentional, not sprayed chaotically. That level of control, that's the ultimate proof of structure winning.
So the market moved by design, not by chaos. And this structural movement, McClarty argues, really validated the core ideas of something called the financial engine framework. We should probably touch on that. What is that framework?
So the financial engine, that's the underlying system D investment enterprise uses. It's built to analyze and prioritize, well, market design and this idea of governed velocity. It's essentially a system for spotting these repeatable structured flow patterns we've been talking about.
And what did this particular week prove about it?
It basically proved that the system's bias, its focus on rewarding structure, and that predictable, consistent momentum, the governed velocity, well, that was the absolute best way to generate alpha during that specific week. The framework nailed it.
Okay, that leads to a big strategic question then, doesn't it, for anyone listening? If capital is moving this surgically, literally out of HSY-RCI and into HPE-USPH, does that mean just passively owning, say, the S&P 500 is kind of suboptimal?
The analysis definitely suggests it's suboptimal in conditions like these. Yeah.
Why?
Because when the market's polarizing so intensely, the index performance is just the mathematical average, right? It's growth soaring minus defensives tanking.
You get the blurry middle ground.
Exactly. You completely miss the alpha, the real edge that was generated by that precise rotation. You only capture the net result, which might look pretty flat or confusing.
So the key takeaway for strategy has to be understand the flow first, then pick the stocks.
That's the argument.
Yeah.
Alpha generation, according to this report, was all about spotting which precise sectors were getting targeted by that governed velocity.
Right.
Which means you need smart, bottle-up stock picking. finding the HPEs and USPHs. But, crucially, you have to do that within a top-down structural framework, like the one this LoopMarket analysis provides. You need the map before you pick the destination.
Understand the flow pattern first. Got it.
This has been a really fascinating look into a market that was apparently defined by clarity, by conviction.
Yeah, it's quite something.
This October 20th, 24th period, seen through this specific lens from Devin McClarty and D Investment Enterprise.
Yeah.
It really showed capital aligning with design, not just reacting to headlines or fear. It validates that structural view.
And what's so striking is just the almost machine-like consistency of it all, that beat-match lag pattern, day in, day out.
Yeah.
If the market really is executing what looks like a predetermined script with that kind of rigidity, well, it raises a massive question for every investor, right?
Which is, what happens when that daily rhythm finally breaks? How fast do you need to shift your conviction when the structure suddenly changes? Because that moment, that transition point, that's where the real danger could lie.
That's a great point. Structure works great until the script suddenly flips on you.
Exactly.
So what does this all mean? I guess it means understanding the design, the structure behind the flow. That's the real edge, maybe.
Seems to be the case here.
Well, thank you for joining us for this deep dive into the LoopMarket Structure Report. We hope you leave with maybe a clearer picture of what governed velocity can look like and why structure matters.